Welcome to Generation Zach. Today we are taking a deep dive into the fascinating history of state banking from 1932 to 1945. This period was marked by significant economic transformations driven by innovative monetary policies. Join us as we explore how these state banking systems rose to prominence, the challenges they faced, and the lessons they left behind. In the early 20th century, state banking emerged as a powerful force, challenging the traditional dominance of private, interest-driven banking systems. The most notable example was the Reichsbank in National Socialist Germany, which played a crucial role in the country's economic revival during the 1930s. This shift towards state-controlled finance was rooted in a fundamental economic philosophy. Money should be a token of exchange for work done, not an instrument of interest and debt. This philosophy significantly influenced the economic policies of Germany under Hitler. The seeds of state banking in Germany were sown by Gottfried Feder, an economist whose ideas deeply influenced Adolf Hitler. Feder's lectures on the abolition of interest slavery resonated with Hitler and became the backbone of National Socialist economic policy. Feder argued for the separation of stock exchange capital from the nation's economic life. This approach aimed to free the German economy from international financial manipulation, promoting self-sufficiency and national prosperity. Upon assuming power in 1933, the National Socialists implemented Feder's ideas through significant monetary reforms. These reforms were encapsulated in the 25-point program of the NSDAP, emphasizing the abolition of interest servitude and prioritizing national interest over individual enrichment. The Reichsbank, under state control, financed massive public works and rearmament programs without resorting to traditional debt. This innovative approach involved issuing non-interest-bearing bonds and promoting barter trade, bypassing international financial systems. The results of these policies were remarkable. Between 1933 and 1939, Germany's economy boomed, unemployment plummeted, and the standard of living improved significantly. State banking facilitated substantial infrastructure projects, increased industrial output, and a rise in national income. However, this success was not without challenges. In 1939, tensions arose within the Reichsbank over fears of inflation. Hallmar Scott, the bank's president, opposed further extensions of state-issued bills, leading to his dismissal by Hitler. This move solidified state control over the bank, but also marked the beginning of external pressures that would lead into World War II. The outbreak of World War II was a turning point. The war was not just a conflict of nations, but also a battle against Germany's state banking system, which threatened the global financial order dominated by the Rothschilds and other international bankers. Despite Germany's numerous peace proposals, the war continued, driven by the fear that Germany's economic model could inspire other nations to adopt state banking, thereby undermining the power of private banks. The defeat of Germany marked the end of its experiment with state banking. After the war, the Deutsche Reichsbank was dissolved and replaced by the bank Deutscher Länder, which eventually became the Deutsche Bundesbank. This marked a return to a more conventional banking model aligned with international financial norms. The legacy of state banking during this period offers valuable lessons. It demonstrated that an economy could thrive without relying on interest-bearing debt. However, it also showed the immense power of international finance to influence global events. The story of state banking from 1932 to 1945 is a compelling chapter in economic history. It challenges us to rethink the role of banks, the nature of money, and the potential for economic systems that prioritize public welfare over private profit. Italy under Mussolini provides another interesting case of state banking. Fascism, often described as the merger of state and corporate power, saw Mussolini taking significant steps towards economic independence. In the 1920s, Italy launched extensive public works projects, creating bridges, canals, roads, and more. Mussolini's banking reforms in 1936 transformed the Banca d'Italia into a state institution, allowing it to issue credit independently from foreign banks. Japan offers another fascinating example. Influenced by C.H. Douglas's social credit theories, Japan reformed its banking system in the early 1930s. The Bank of Japan began issuing state credit to fund industrial expansion and national development. From 1931 to 1941, Japan's industrial output and national income grew significantly, positioning it as the leading economic power in East Asia. However, tensions with the United States over resources led to economic sanctions, pushing Japan towards war. Moving to a more contemporary example, let's look at the State Bank of North Dakota in the United States. Established in 1919, it remains the only state-owned bank in the country and serves as a remarkable example of state banking in practice today. North Dakota State Bank has played a crucial role in the state's economic success. By providing financial services that promote agriculture, commerce, and industry, the bank has contributed to the state's prosperity and resilience, especially during economic downturns. In the early 19th century, the small island of Guernsey faced economic challenges but turned to an innovative solution: state-issued currency. By issuing debt-free money, Guernsey funded public works, stimulating the local economy without incurring debt. This experiment led to significant economic improvements, demonstrating the potential of state banking to foster economic growth and stability. Today, Guernsey enjoys one of the highest standards of living, partly thanks to its unique financial policies. These historical examples reveal both the potential and pitfalls of state banking. They highlight how state-controlled finance can drive economic growth, reduce unemployment, and increase national prosperity. However, they also underscore the risk of international isolation and conflict. As we reflect on these lessons, we must consider how modern economies can balance the benefits of state banking with the realities of global finance. Could a hybrid model that incorporates elements of state control and private enterprise provide a sustainable solution? As we navigate current economic challenges, revisiting these historical lessons can inspire new approaches to creating a more equitable and sustainable financial future. What do you think about the potential of state banking in today's world? Thank you for joining us on this journey through the history of state banking. If you enjoyed this video, please like, subscribe, and hit the notification bell for more insightful content.